Okay, so what we've addressed so far is the fact that asset allocation has a large impact on portfolios, the fact that that asset allocation or tactical asset allocation is likely to continue to be a robust method to find alpha because there are some structural barriers to arbitrage. But of course, the question is how we put all of this together, right? How do we find a methodology that we have a high level of confidence that will work going forward, given what we've seen in the past? So this is where adaptive asset allocation comes in. Okay, so what we're going to do now, and as I mentioned before, the previous two presentations, we focus on understanding correlation and trying to estimate correlations across asset classes, understanding each asset class's volatility and trying to estimate that. But today we're also going to focus on the momentum factor, right? This well-documented factor that that basically allows us to have a better estimate of returns for our portfolio, and we'll get into how we add value there. But the way we like to show the incremental benefit of observing and estimating each one of these parameters is by starting with a base case, right? Assuming that I can't estimate correlation, volatility, or momentum. And if I can't estimate it, but I have come to the conclusion that being global and having global diversification is important, then what's the best way I can allocate across those asset classes? So what I have here is a series of just 10 asset classes that represent over 90% of liquid available assets in the world. U.S. equities, European equities, Japan, emerging markets, domestic equities, international real estate. And then we have some of the alternative asset classes like short-term and long-term treasuries, commodities, and gold. Okay, and what I'm saying here is that if I don't know anything and I cannot estimate anything, it follows that the only optimal portfolio here would be an equal weight portfolio, right? So what I'm going to do as a base case, I'm going to start with an equal weight portfolio where at the end of each month, I'm merely going to rebalance back to 10%. And I'm going to do that from 1995 to today. And we're going to see what the results are. And then what I'm going to do is I'm going to apply a volatility estimate, a momentum correlation estimate, and a momentum estimate, and see how we can improve. So here we are, 10 asset class universe, rebalance back to 10% at the end of each month. And what we see here is that we have an 8.2% rate of return, a 12% volatility, annualized volatility, which is the equivalent of a balanced fund portfolio, right? Balanced funds generally average around 12%. This is an important number for us. Over 12-month rolling periods, how often are we positive? Here it's 76% of the time. So from January to January, February to February, how often am I saying I made money to the client? How often am I saying I lost some money? 24% of the time we're losing money. And some of the times it's negative 44%, right? Which is the peak to trough loss, a maximum loss for this particular portfolio. And that would have happened here in 08. And of course, the return to risk ratio is the Sharpe ratio. So for the return divided by volatility is 0.48. We want to see if we can improve on this. And so what we've done so far is we've assumed that every one of these asset classes provides the same amount of risk and return to the portfolio, right? But when we actually measure the volatility of the overall portfolio, which comes in around 12, right? If we measure the volatility and then disaggregate those asset classes that have what each asset class contributes to that volatility, we find that this assumption that everybody's contributing the same risk isn't true. This is just what you can see here: emerging equities, European equities, REITs, Japanese equities are contributing the vast majority of the volatility of the portfolio, but the risk that we can get from treasury bonds and medium-term treasuries and gold and commodities isn't that much. It's not equal here. And so the risk can actually be good. We want diversification benefits, right? So what I mean by risk contribution is what we find in this portfolio is that we're letting the maniacs take over the asylum. Emerging markets have a volatility that range that go up and down this way. And if we measure the impact of volatility of bonds, they may be going the opposite way, but their impact isn't that much, right? So we have a disproportionate amount of risk happening from emerging markets. So what we want to do is we want to go back to a rebalancing methodology. And instead of saying, look, I'm going to give everybody $10 for every 100, instead what I want to do is ensure that each asset class is weighted in such a way where their risk contributions and their volatility is equated across the board. So you can see if I do that, if I measure the recent volatility for emerging markets and US equities and 7 to 10-year treasuries, and I want to equate their volatility so that emerging markets does this and 7 to 10-year treasuries do that, we can see that that's what we want to do. We want the ranges to be fairly similar. And to do that, you need to have a much larger weighting to 7 to 10-year treasuries and a much lower weighting to emerging markets. And this is just a point in time, right? So August 13th, 2012, had we measured the recent standard deviation of all of these asset classes and made it so that each of them contributed the same amount to the portfolio, this would be their weighting. So what I'm going to do in this next example is I'm going to play some defense. This is really about minimizing the downside. And by, at the end of the month, rebalancing back to equal risk contribution rather than equal dollar amounts, what we get is similar return profile, but the volatility goes down to 9%. That's equal to a corporate bond portfolio. The positive rolling periods go to 82%, and now we're looking at a maximum peak to trough loss that's been basically cut in half. Right? Sharp ratio is also going up by 20 basis points. So clearly, there's a benefit of weighting asset classes in a more unique way, right? In a way where we're actually trying to find real balance across these asset classes. But the question is, aside from managing volatility, is there a way for us to minimize downside and actually gain some returns? Can we play some offense by observing another factor, right? We've just looked at the volatility factor. We talked about the momentum factor, this idea that we can capture better returns by observing asset classes that have recently done well. And what this chart shows, if you haven't seen it before, this is a market quilt that just basically ranks some of the asset classes from best performing to worst performing. Right. So here you can see in 2000, commodities were at the top. You got treasuries, real estate, Canada, gold, U.S., world, and every year we're ranking from best to worst. So what do we find? Well, what we find is that every single year, when you're looking at asset classes, there are big winners and big losers, right? In periods like the tech crisis, where most portfolios that investment portfolios lost a lot of money, we can see here that had you invested in commodities and real estate and treasuries, you would have done double-digit returns, right? There are asset classes that do really well. In 2008, had you invested in U.S. treasuries, you would have been up 63%, and gold, 28%. And the question is whether we can capture some of those winners and do a better job at portfolio construction. And so we go back to momentum. What we're going to do in this next example is we're going to just, instead of investing in all 10 asset classes, what we're going to do is we're going to invest in the top 5 and eliminate the bottom 5. So every month we're going to rank performance over the last 6 months for these asset classes, and we're going to keep the top 5, eliminate the bottom 5, then risk weight those 5 asset classes that I'm holding for 1 month, and do it again the following month, right? So every month we're getting the top performing asset classes, and we're risk weighting them like we did in rule number 1. So when we apply those 2 rules, what we get is a bump in return. Volatility goes up a little bit, but we'll address that in a second. You're looking at 90% of 12-month rolling periods. Your Sharpe ratio goes up, and now your maximum peak to trough also goes down. Right? So the clear benefit from harvesting that momentum factor at the asset allocation, at the asset class level. But so far, all we've done is really looked at each asset class in its own silo. We're looking at each asset class and its volatility, each asset class and its momentum. But we haven't really looked at the benefit of diversification. That is, understanding the co-movements between one asset class and another. Right? So in this final example, what we're really doing is we're trying to measure the correlation across all these asset classes to get better risk management. Right? And it's the idea of putting together 2 asset classes that have expected positive returns. So this blue line goes up and this light blue line goes up, but they move differently from each other. You put them together, you have a much smoother ride. Right? This is the idea of a ski company, it'll make money over a full 12-month period, and a bike company will also make money over a full 12-month period, but they're better together, right? You put those together and the cash flows are much smoother. So if I if I now have a correlation estimate, volatility estimate, and a return estimate through momentum, I can now apply an optimization technique, do minimum variance. So grab the top 5 asset classes, do a minimum variance optimization that takes into account correlation and volatility, and now we actually increase the risk-adjusted returns a little bit better, right? So that's that purple line at the top. You're looking at better returns. Volatility goes down now because we are taking into account the correlation. Number of 12-month rolling periods goes up to 93%, Sharpe ratio goes up, and the maximum peak to trough loss is negative 14%, which is a drastic improvement.